There are over 7,000 exchange-traded funds available to investors today, yet most people have never owned a single one. The irony? ETFs might be the simplest, most accessible investment tool ever created. And by the end of this video, you'll understand exactly what they are, how they work, and why they could be the foundation of your entire investment strategy. Welcome to Money Grows on Trees, where personal finance gets simple. Today, we're breaking down ETFs, or exchange-traded funds. No jargon, no complexity, just a clear explanation of what they are, how they work, and whether they belong in your portfolio. An ETF, or exchange-traded fund, is essentially a basket of investments that you can buy as a single unit. Think of it like a pre-made gift basket at a store. Instead of going out and buying individual items, a chocolate bar here, a candle there, a card over there, you buy one basket that already contains all of them. With an ETF, instead of buying individual stocks like Apple, Microsoft, and Google separately, you buy one ETF that holds all of them, plus potentially hundreds more, in a single purchase. The exchange-traded part means you can buy and sell ETFs on a stock exchange. Just like individual stocks, you place an order through your brokerage account, and you own a piece of that entire basket within seconds.
So why not just buy individual stocks? Let's compare. When you buy a single stock, your entire investment depends on the performance of one company. If that company has a bad quarter, faces a scandal, or gets disrupted by a competitor, your investment takes the hit. It's high risk, high potential reward, but also high potential loss. When you buy an ETF, your money is spread across many companies at once. If one company in the basket performs poorly, the others cushion the blow. This is called diversification, and it's one of the most important concepts in investing. Here's a simple way to think about it. Buying one stock is like betting everything on one horse in a race. Buying an ETF is like betting on all the horses at once. You won't win as big as the single best horse, but you also won't lose everything if your pick comes in last. Not all ETFs are the same. Here are the main types you should know about. Index ETFs track a specific market index, like the S&P 500. When you buy an S&P 500 index ETF, you own a tiny piece of the 500 largest companies in the U.S. This is the most popular type of ETF for beginners. Sector ETFs focus on one industry: technology, healthcare, energy, real estate. These let you bet on a specific sector without picking individual companies. Bond ETFs hold bonds instead of stocks. They're generally lower risk and provide regular income through interest payments. Many investors use them for stability. International ETFs track markets outside your home country: emerging markets, Europe, Asia. These give you exposure to global growth. Dividend ETFs focus on companies that pay regular dividends, providing a stream of passive income.
ETFs make money in two ways. First, through price appreciation. If the underlying investments in the ETF increase in value, the price of your ETF shares goes up. You can sell them later for a profit. Second, through dividends. Many companies in an ETF pay dividends, a portion of their profits distributed to shareholders. The ETF collects these dividends and passes them on to you. You can either receive them as cash or reinvest them to buy more shares. Over the long term, reinvesting dividends is one of the most powerful wealth-building tools available. It's how compounding works, which we'll cover in depth in our next video. You might be wondering, how are ETFs different from mutual funds? They're similar in concept, both are baskets of investments, but there are key differences. ETFs trade throughout the day on exchanges, like stocks. You can buy or sell at any time during market hours. Mutual funds are priced once per day, after the market closes. ETFs typically have lower fees than mutual funds. The average ETF expense ratio is around 0.2%, while many mutual funds charge 1% or more. ETFs often have lower minimum investments. You can usually buy a single share for the price of one unit, whereas mutual funds may require a minimum investment of $1,000 or more. For most beginners, ETFs offer the simplest, cheapest way to start investing.
Now, some risks to be aware of. ETFs are not risk-free. If the overall market drops, your ETF will likely drop too. Index ETFs track the market, so when the market falls, your investment falls too. Sector ETFs are riskier than broad market ETFs because they concentrate on one industry. A technology ETF could lose significant value if the tech sector has a downturn. Leveraged and inverse ETFs use complex financial instruments to amplify returns or bet against the market. These are designed for short-term trading, not long-term investing. As a beginner, avoid them. If you want to start investing in ETFs, here's what to do. Step 1. Open a brokerage account. In the U.S., popular options include Vanguard, Fidelity, and Charles Schwab. In Canada, consider Wealthsimple, Questrade, or your bank's brokerage. Many offer zero-commission ETF trades. Step 2. Choose a broad market index ETF as your starting point. An S&P 500 or total stock market ETF is the most common first choice for beginners. Step 3. Start small. You can begin with as little as one share. What matters is starting, not the amount. Step 4. Set up automatic contributions. Even $100 per month invested consistently builds significant wealth over time. Step 5. Be patient. ETFs are long-term investments. Don't panic sell during market dips. Historically, broad market indexes have always recovered and trended upward over long time periods, though past performance doesn't guarantee future results. ETFs are one of the most powerful tools available to everyday investors. They offer diversification, low costs, and simplicity. Everything you need to start building long-term wealth without picking individual stocks. If this was helpful, subscribe to Money Grows on Trees for a new finance breakdown every week. In the next video, we're visualizing compound interest, the single most powerful force in personal finance. Remember, this channel is for educational purposes only and is not financial advice. Always do your own research and consider consulting a licensed financial advisor for your specific situation.